Mr. Lee runs a successful hotel business. The company wants to expand and build a new hotel in a new city, but the company doesn't have enough money to pay for the cost of building the new hotel. Mr. Lee has a great relationship with his banker, but the construction will cost $50 million, and the bank cannot give him a loan for that much money. The banker suggests that Mr. Lee's company could sell bonds to raise the money. Bonds are like IOUs. They are sold to lots of different buyers, and the bond buyers will effectively lend Mr. Lee's company money. Each bond obliges the company to pay interest to the bond buyers and to return their money on a specific maturity date in the future. The bond buyers can hold the bonds until the maturity date, or they can sell them to someone else before that. If the bonds are sold, the new owner then gets any further interest payments and loan money when it's repaid. And bonds can be traded, so the original buyer does not need to be the final holder of the bond. The banker arranges the bond issue for Mr. Lee's company. As part of the process, the bonds are assessed and rated by a rating agency. This rating gives potential bond buyers an indication of how much risk they will be taking if they buy the bonds. Most importantly, will Mr. Lee's company be able to pay the interest and loan repayment? The banker then contacts lots of bond investors and arranges for a large number of them to buy the bonds. During this process, the annual interest rate that Mr. Lee's company will need to pay is determined. The rate depends on what the investors will be willing to accept on the basis of the risks that they face by lending money to Mr. Lee's company. In the end, each of Mr. Lee's company's bonds of $1,000 will pay an annual coupon of $50, giving a 5% annual return to the bondholders. Once the bonds are sold and Mr. Lee's company has the money, they build the new hotel. 5 years later, the hotel has been a great success for Mr. Lee's company, and they have paid the annual interest every year. The company also has more than enough money saved to repay the bondholders. Each bondholder is repaid $1,000 for each bond that they own. In summary, bonds are like IOUs that are sold by borrowers, who can be companies and other entities like governments, to groups of investors. Each investor is paid interest on a regular basis and will expect to get their money back on a future maturity date. The borrower uses the money to finance its operations or new projects. The investor takes the risk that the borrower could go bankrupt and be unable to pay the interest and the final repayment on the maturity date. Bonds can also be traded, so the original buyer can sell the investment to someone else, who will then receive the interest and repayment amounts from that point onwards. Investors typically buy bonds because they are looking for a steady income from their invested money. They may or may not hold them until maturity.